Mortgage rates could come down, but probably not as fast or as far as many buyers and investors hope. The big story is not a dramatic collapse in rates. The bigger story is whether they drift lower enough to change buyer behavior. A move from 7% to 6% feels small on paper. In monthly payment terms, it can be a very big deal. And for investment property, rate changes can affect cash flow, cap rates, prices, refinancing options, and exit timing all at once. So let us break down what is expected next, what could delay lower rates, and how this may reshape the housing market in 2026. Freddie Mac showed the average 30-year fixed mortgage at 6.65% for the week ending March 26, 2026. That is lower than peaks but still elevated. That tells us rates have already eased some, but they are not yet low enough to feel easy for the average borrower. Forecasts from major housing groups point to modest declines, not a plunge. That is the key takeaway if you are planning around rate relief. Fannie Mae projected in its April 2025 outlook that mortgage rates end 2026 around 6%. That suggests a slow step down, not a sudden break lower. The National Association of Realtors also said rates in 2026 may average around 6%. Again, the signal is gradual improvement. So yes, rates may come down soon in a mild sense, but soon does not necessarily mean cheap. Think of mortgage rates like a heavy garage door. Once it starts coming down, it still does not slam shut all at once. Mortgage rates do not move one for one with the Federal Reserve. They are influenced heavily by bond yields, inflation, and investor expectations. If inflation cools more convincingly, long-term yields can ease. That usually gives mortgage rates room to drift lower too. But if inflation stays sticky or growth remains stronger than expected, rates can stay higher for longer, even if people keep waiting for cuts. There is also the mortgage spread. Lenders price in risk, funding costs, and volatility. That means mortgage rates can stay elevated above Treasury yields. The best case for borrowers is a gentle decline in inflation, calmer bond markets, and no major economic shock. That would support a slow move towards 6%. The risk case is simple. Inflation re-accelerates, deficits keep pressure on yields, or markets demand more return. Then mortgage relief gets delayed. This outlook comes from Freddie Mac weekly rate data, plus forecasts from Fannie Mae and the National Association of Realtors. If rates ease even modestly, more buyers can qualify. That tends to bring demand back into the market fairly quickly. Many households are payment sensitive, not just price sensitive. A lower monthly payment can bring buyers off the sidelines fast. That is why industry forecasts expect home sales to improve as rates move lower. More affordability usually means more transactions. Still, lower rates do not guarantee a buyer-friendly market. Inventory remains the swing factor. Many owners still have ultra-low mortgages from earlier years. They may keep staying put, which limits resale supply. Home builders can help fill some of the gap, but construction costs, land constraints, and local rules still limit how fast supply can grow. So the likely outcome is more activity, not a flood of cheap homes. Rates easing could lift demand faster than supply. That means national home prices may keep rising, but probably at a more moderate pace than in the hottest pandemic years. Investment property reacts to mortgage rates a little differently than owner-occupied housing. Investors care about payment, but they also care about yield. When borrowing costs fall, monthly debt service can improve. That makes some deals pencil out that did not work before. As financing gets easier, more investors may compete for the same good properties. That can push prices up, especially for quality rentals. Lower rates can also compress cap rates if demand returns. In plain English, buyers may accept a lower yield and pay more upfront. This will not happen evenly. Some markets have rising inventory, weak rent growth, or soft migration trends. Those areas may stay under pressure. The Mortgage Bankers Association has noted that housing conditions are very location-specific. Some markets are seeing softer prices, while others remain tight. Single-family rentals may benefit if people still cannot afford to buy. That keeps tenant demand firm, even if purchase demand improves. Multifamily is more complicated. New supply in some cities can pressure rents, which may limit how much prices rebound. So, if rates fall modestly, investment property prices could rise in strong markets, but weak rent markets may not get the same lift. First, watch inflation data. That is still one of the biggest drivers of whether mortgage rates keep easing. Second, watch the 10-year Treasury yield. Mortgage pricing often follows its direction more closely than headlines about the Fed. Third, track inventory in your target market. National averages matter less than neighborhood-level supply and demand. If you are investing, watch rent growth and vacancy just as closely as mortgage rates. Cheap debt does not fix weak income. Also keep an eye on refinancing windows. A modest drop in rates may not transform a purchase, but it can improve long-term returns later. The smartest approach is to avoid extreme predictions. Rates do not need to crash for the market to change meaningfully. A realistic base case is slow improvement in affordability, better sales activity, and uneven price performance across different property types and cities. So, are mortgage rates coming down soon? Probably yes, but gradually. And that one word matters most. Gradually lower rates could wake up buyers, increase sales, and support prices. But limited inventory may keep housing from becoming truly cheap. For investment property, lower rates can improve deal flow and valuations, but local rent trends and supply still decide which markets win. If you want, I can also break this down by rental property, house flipping, or the cities most exposed to lower mortgage rates. Subscribe and drop your market in the comments.